With the caveat that because there's so many moving parts politically and things can change very quickly, they could do an intentional dollar devaluation, which would be probably really good for a lot of assets. They could radically escalate the tariff war, which could be quite negative for asset prices. So this is kind of a headline type of year. I do think this is also a year, one of the more actionable things I think an investor can do is do a valuation checkup on a lot of their assets, because when you have structurally rising liquidity, valuations tend not to matter. So valuations are generally not going to tell you what 1 year stock performance is going to be. But valuations do matter at inflection points, and they do matter for like 5-year return prospects. And when you look at how assets are priced, so you generally don't see a lot of excess like foreign developed or emerging market equities. You generally don't see a ton of valuation excess in, medium-sized US equities, although there is some. And instead, some of the valuation excesses are concentrated in the mega caps. And not just in tech. When the dot-com bubble was happening, everybody's kind of focused on the Ciscos of the world and the Microsofts of the world and how expensive they got. But at the same time, there were companies like Walmart and Coca-Cola trading at 50 times earnings in the late 90s. And what happened over the subsequent 10, 15 years was their earnings, kept increasing, went on to double and more, but their valuations got cut in half or more. And so the stock price would basically be dead for a decade. And there are a number of assets like that today, like Costco trading at well over 50 times earnings, Walmart trading at like 40 times earnings. There has been this kind of rush for structural, high quality, blue chip, large cap, even outside of tech. And if you do start to get worsened liquidity situations or rotation in capital, I would be concerned around assets that are, growing earnings at 10%, but then they're trading like Nvidia, they're trading at like say 40 or 50 times earnings is where I'd be concerned. I would characterize this environment as less bubblicious than the dot-com bubble in the sense that the Mag 7, there are differences between them, but in general, they're doing well because they have a lot of earnings rather than just because they have a lot of revenue or clicks, like is what you saw in the dot-com bubble. So this is actually backed by profits. And we've actually seen a pretty sharp distinction, which is during, say, the whole 2020-21 period, lots of unprofitable tech, what was soaring, kind of things that like ARK would invest in, not to criticize them, but to think of a type of bucket. Whereas this kind of post 2022 bull market in assets has been more of that hyperscaler profitable type of company that's, soaring to new highs, while a lot of that unprofitable tech is not. That's probably the optimistic side, is that there are more fundamentals backing up that concentration now than there were in the dot-com era. Where I do think we have similarities is, I think the risk is that GPU CapEx is still more cyclical than people think. I think the risk is people are pricing it now as though that's no more cycles. It's just structurally higher. We need more GPUs every year now. NVIDIA's beyond cycles. That's kind of the bullish thesis for that space. Whereas the bearish thesis, which I would generally subscribe to, is that we probably will see or are seeing over CapEx in that area. And then we'll see a contraction period before, potentially going to new all-time highs, but that there probably will be some sort of digestion period. Maybe not as long as like the, optical fiber CapEx oversupply that happened in the dot-com bubble, but that you could get a couple year cycle of, hey, we have too many of these GPUs. We actually don't need this much CapEx. Time to kind of digest what we already have. I think that's probably the base case. And, the DeepSeek model potentially shows that maybe you don't need as much GPUs as you think for a given level of task. Another thing that's kind of broadly worth considering is where is value accrual going to occur with AI? So in the prior, 10, 15 years of the rise of social media and these big tech stocks, value accrual kind of concentrated in these big monopoly types of entities. If AI ends up being more open and more capital intensive, you could see a situation where their margins are not that great. And ironically, the biggest beneficiary is the consumer that has access to relatively cheap AI to expand the things they can do, but that there's no, multi-trillion-dollar value accrual to too many companies out there other than maybe the GPU makers. And I think that's worth seriously considering, because when you look around at profitability, very few AI services are profitable, even the most successful ones. So far, the big profit has been the GPU makers, NVIDIA specifically, and Taiwan Semi and a couple others. And the risk is that as that dries up, we could also see that companies like Microsoft or Alphabet or Meta or others, although they're spending a lot on CapEx, they're maybe not getting profits from doing so, and that they can't raise the price of their products enough to offset the CapEx, or that they just kind of roughly keep pace with it so they don't get this structural new growth from it. They're just kind of maintaining what they already have. And if that were to happen, that's, I think, a challenge to the Mag 7 thesis. at least at these levels of valuation. So you could see a few years of just them chopping along sideways, letting earnings kind of catch up to what they've already priced, kind of seeing what the actual sustainable growth rate is here. I think it's a bubble worry for those that are heavily invested in US indices, less of a bubble worry if someone has a diversified portfolio. And that's, it kind of balances itself out because, for the past 5, 10, even 15 years, diversification has generally been punished. It's generally been good to just be like, I'm just long, large US stocks. And a lot of, whether it's a macro analyst or a frequent trader, they generally don't like markets where just buying a simple index, it just goes up every year because that's a hard benchmark to compete with. They generally like years where like gold is outperforming stocks or emerging market equities are outperforming, US big tech, or where markets go down or sideways for a year and alternatives outperform. That's generally where it's easier to make alpha. I do think that there's a risk there that too many people who would benefit from rotation are always expecting a rotation. So that's one thing I always try to caution myself against, because if I look over the past 5+ years and say, okay, I got a lot of things right, but I did get some things wrong. What are my biggest things I get wrong? It's generally expecting trends to change prematurely. And specifically for me, it's the timing around concentration of US growth stocks into other types of equities. That's been my kind of limiter, which has been offset by the fact that I'm on the right side of fiscal, the right side of assets like Bitcoin or MicroStrategy, getting some of those big trends right, but then always being a little bit more optimistic than I maybe should be about rotations into broader equities. That's probably been my anchor. So I have to be a little bit cautious about that. But I do think that as we look forward over the next year or two, this is kind of a window for rotation to occur. And rotation can be very disruptive for concentrated indices. I think gold's still in a pretty attractive place in the sense that there's certain periods of euphoria temporarily, but it's not a structurally overbought asset. And there's generally good fundamental reasons for the rally behind it, which is to say that central banks around the world are generally wanting to hold a more debasement resistant asset they can hold in their own vaults, therefore is resistant to confiscation or seizure. And we see a number of people in China and other countries where they look around and they say, I don't really like the real estate market, I don't really like the equity market, but gold still looks attractive. So while I generally don't try to predict 12-month price action on gold, I do generally view it as more attractive than bonds, at least as replacing a chunk of bonds in a portfolio. So over the past 5 years, I've been super bearish on bonds and pretty bullish on gold, and that's been a good trade. While I do think that there will be, and have been, there will be counter years where bonds do particularly well and gold, chops along flat, I still structurally like gold more than many other defensive assets. So when we did a liquidity analysis on different assets, gold was somewhat mixed in terms of how much it correlates with liquidity. And a big component of liquidity is that dollar strength. And that's because when there's good liquidity, generally, and that often includes a weaker dollar, generally speaking, investors flock to risk assets. So equities, Bitcoin, that type of thing. Whereas when there's reason to be concerned, either because liquidity is bad or for other reasons, investors generally flock to, bonds and gold. And so gold's kind of got this mixed bag where on the one hand, it does benefit from debasement and a weaker dollar. On the other hand, it does also benefit from people coming to defensiveness while the dollar's strong and liquidity is not great. I do think that can give you a second leg. It partially come to how well are big US stocks doing, right? Because if investors say, well, if we're weakening the dollar and Bitcoin's going vertical and equities are going vertical again, then maybe I just want to be in there rather than gold. Whereas if you have more of that stagflationary environment where maybe tariffs put prices up, and so maybe you get slowing growth and you get squeezing margins, and then you get a weaker dollar, that could be an environment where, say, gold outperforms equities. I would generally need more information to know what to expect in that environment, but I do think that's one of the potential tailwinds for, breaching above 3,000 or otherwise getting higher than we currently are. There's a couple of different lenses that I look at Bitcoin through. So one is that tight correlation with liquidity. Right now, liquidity is kind of flattish. I also look at Bitcoin through the lens of regulatory clarity. So there's a lot of companies that wouldn't touch it, but then once it got a spot ETF and once you have a Trump administration election, they shifted their views on the acceptability of the asset from a tail risk perspective. And then in addition, I look at on-chain indicators. So mainly what I look for is not to use them as trading per se, but to look for major risks. So in years years like 2021, 2017, and certain other years, there were on-chain metrics that showed a high degree of euphoria. So my favorite is market value compared to on-chain cost basis. And when that ratio gets really high, there's a risk of a multi-year correction. And currently, Bitcoin's not trading at levels using that metric and similar metrics that indicate a high likelihood of a multi-year correction. Instead, it still looks fairly mid-cycle. It still looks fairly conservative in terms of overall euphoria around the asset, at least the quantitative things I look at. And so I think that the majority of indicators suggest that this cycle still has room to go. So I'm generally bullish with, say, an 18-month view, but I would expect turbulence along the way. And if we have any sort of sharp contraction in liquidity, like we saw recently with some of these tariff announcements, kind of spiking dollar and sell-offs in risk assets, that's when you could see some turbulence in Bitcoin. There's a combination of defensiveness and offensiveness that makes sense. So I think that there's the classic phrase that I most agree with, which is that, there's more money lost from people worrying about bad things happening, that they're always kind of missing out on gains. And so I think that keeping that in mind, I think a way to manage concerns around that is to say, look, there are concentrated areas, but never forget that there are pockets of cheapness elsewhere. It could be a certain factor, it could be a certain location, it could be a certain asset class, but in any given time, there generally are things that are on sale. And so I think defensiveness tempered with, okay, so I'm concerned about some things, so I'm not necessarily concerned about everything. How can I diversify to a reasonable degree that I'm leaning in to what I think is fairly cheap is probably how I would approach it, which is conservative risk taking.